My name is Jeffrey Kennedy and welcome to Trader's Classroom. Regardless of how long you've been trading, one of the things that we always have to be on guard against is that feeling of rushing into a trade. And you know exactly what I'm referring to. That feeling that you get right before you execute a position where I gotta get in now, because if I don't get in now, I'm going to miss the opportunity. Well, many times that will adversely impact, I think, your trading results. If I had simply just waited another day or two, I could have avoided, more often than not, a losing trade. So that being the case, what I do for my own trading is I incorporate different techniques that essentially force me to wait. So therefore, I'm never rushing into a trade because I never want to execute a trade based on emotions, whether that's fear, greed, ego, doesn't matter, okay? I want to be very methodical. I want to be very disciplined in my trading. I want to pull the trigger when it's ripe. So what I want to talk to you today about is one of the techniques I employ that prevent me from rushing into taking a trade. So let's begin. Okay, well, if you've ever been to a carnival, I'm sure you've seen the little, those little games where you might have like a little water gun and you have like little ducks moving across the background and you're supposed to knock over one of the little moving ducks with your water gun or your pellet gun or whatever. Well, the question is, how do you hit a moving target? Well, the answer is actually quite simple. You aim in front. Okay, that seems simple enough. Now let's apply that same logic to financial markets, because financial markets are also moving targets. Okay, like for example, let's look at this little diagram that I've got in front of us. Let's say that we've traced out 5 waves up for wave 1 and that we're now in somewhere in wave 2. Say, for example, we're right here in wave 2. Oh, before I get too deeper into the discussion, I want to make a comment. I have received some emails recently asking me a lot of questions about wave 1, this advance right here. And basically the email had to do with, Jeff, you never really talk about wave 1 or trading wave 1. Why don't you ever do that? Okay, well, it's quite simple in that, okay, by the time I recognize that a wave 1 is indeed a wave 1, at least 50% of the move is already transpired, or maybe even say 80% of the move, okay? Well, if I recognize, say, midway or even later on, that this is indeed a first wave up of a larger impulsive structure, if I pull the trigger then, well, what happens next? We go up a little bit higher for a day or two. I feel real good about everything. And then I have to survive and live through the drawdown in wave 2. So that's why I usually let wave 1 and 2 go. I really don't see those as prime or ideal trading opportunities. And I usually use those as my foundation for subsequent, say, building of structure of whatever analysis I'm using. But these are essentially this initial up-down sequence, the 1 up, the 2 down, or the A up, or the B down. Those are my setups. Okay, so that's why I really, again, don't view wave 1 as that high of a probability trading opportunity, because by the time you recognize it's wave 1, the next thing you get to look forward to and live through, unfortunately, is the drawdown that you'll experience in wave 2. Okay, so let's go back to today's topic. Aim in front of your target. How do you hit a moving target? You aim in front. Financial markets are moving targets. So a lot of times whenever we see the initial 5-wave move up and the subsequent 3-wave decline, let's say we're somewhere midpoint, okay, right here. Many of us mistakenly, in my opinion, humble opinion, is that we stress too often over, okay, 5 down, 3 up, followed by another 5. Okay, I have to pull the trigger now. If I don't pull the trigger now, I'm going to miss the trade. I've got to act now, 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 now. Hurry up, hurry up, hurry up. You know exactly what I'm talking about. Because if I have those feelings, those emotions at times, I know you do as well. And whenever you make a decision based off emotion, fear, greed, or ego, or self-doubt, more often than not, it tends not to end well. So rather than stressing about being able to tag wave C of 2, why not aim in front? Okay, so if you recognize, say, midway here within wave 2, maybe we finished waves A and B, okay? Well, that means you need to see wave C and then another advance and a decline. So aim in front, wait, okay? And by waiting, what you do is you allow the market to mature, and better yet, provide the price action that you need to confirm your actual assessment. So by slowing down, okay, and by aiming in front, what you do is you begin to avoid the pitfall of rushing into a wave count, because again, like you, it's happened to me more times than I care to admit, where I'll go, okay, hey, that's a nice ABC decline, that's a 535, that's a zigzag, that's done, that's down. I buy the market, and then all of a sudden, boom, next thing you know, you're looking at a WXY, okay? How many times has that happened? Well, it happens to all of us. And one of the ways I've kind of figured out or come to resolve as far as that issue is to simply slow my trading down, okay? Aim in front of the target, okay? So that's one of the things I'd like to suggest. Slow down, you know, again, don't rush. There's no need to rush into a trade. Now, one more thing, because I know I'm going to get some emails on this. Well, Jeff, I've tried that, and when I do that, I miss opportunities. Okay, hey, I'm right there with you. Okay, just take a look at Z-Lab and you know exactly what I'm talking about, because that was an issue I was looking at the other day. Yes, you will miss opportunities. You'll be waiting for the market to come back and it never does, and it just screams out of the pocket, so to speak. That will happen, okay? But don't worry about it, because there's always going to be another opportunity, okay? There's not just a single opportunity, and this actually speaks to a deeper issue as far as your mentality and how you see and view the world, okay? Do you have an abundance mindset? Do you see opportunity everywhere? Or is opportunity one of those things that you think is in a limited supply, and that if you don't act now, you're never going to get another chance, okay? Well, try and stop thinking that way, because that's not true, okay? Remember, fear is like, what do they say? False expectations appearing real, okay? There's always going to be an opportunity. There's always going to be another Amazon or another Bitcoin or another high-flying opportunity out there. Just as long as you're able to recognize it and then ultimately take advantage of it, that's what will serve you in the long run. Okay, now let's look at a few price charts. Okay, you get the main idea. Aim in front of your target. That will slow your trading down. Okay, Pan American Silver Corp, ticker symbol PAAS. And by the way, we will be talking about this price chart and this wave structure here. But by the way, I do recommend right now, if you have the time, take a look at some of the metals, metal stocks. They're looking quite interesting. Okay, and that's all I really need to say about that issue. Okay, bottom line, blank price chart. Pause the video. Give me your best wave count. Okay, well, welcome back. Okay, well, the one thing that I would not do is identify this. Hey, let's go through some of the processes that I go through. Okay, we know what the 5 core Elliott wave patterns are, I hope. Impulse wave, diagonal, zigzag, flat, and triangle. Okay, so beginning from the high, right here, do you see an impulse wave? And not just like look at this single price move. I'm talking about take it in. It's kind of like looking at, you're on the edge of the Grand Canyon. What do? You take in the entirety of the view. You just don't look at a single rock on the ground at your feet. You look at the whole panorama, the vista, the beautiful view, okay? So is this what I've identified in the little yellow box, or actually big yellow box? Is this an impulse wave? No. Is this a diagonal? No. Is this a zigzag? It's an ugly one. No. Is this a flat? Okay, no. Is this a triangle? Probably not. Is this any, okay, so I really can't easily discern any of the 5 core patterns. Okay, well, Jeff, we've never gone this far before in our decision-making process or in our analytical skills as far as applying the wave principle correctly and successfully. Okay, because usually if we go through the 5 core patterns, we can find something. Okay, so what do? What question do you ask next? Well, you basically dilute it a little bit, because remember, the way the wave principle functions is it classifies price action into two distinct modalities. You've got motive waves, and then you've got corrective waves. Okay, motive waves include the impulse wave and the diagonal. Corrective waves include the zigzag, the flat, and the triangle. Okay, so is this in the box motive wave price action? No. Then that means by default it must be a correction. Therefore, we know it's a counter trend move, and we know that it's ultimately going to be more than fully retraced. Now, I kind of played with this last night after dinner, and there are really several different interpretations. None of them incorporate or include an impulsive wave count. None of them. But I did come up with some variety of interpretations. You can label this structure as a flat. You can label this structure as a double WXY. It doesn't work well as a triple correction, so I kind of avoid that. But the simplest interpretation, or the straightforward interpretation, or the one reason I wanted to point this out today, and one of my subscribers in my Commodity Junctures live event yesterday asked me to take a look at the silver market, and it was just like, wow, that's kind of an exciting, there's some stuff going on in the silver market or silver price chart. If you trade silver futures, that I was like, I want to spend some more time with this price chart because it looks very, very interesting. Thus, I wanted to look at some actual individual stocks. So the way I always try and avoid a WXY if I can, but a WXY in this case here, because of the ugliness, and that's an industry term, by the way, it's ugly all day, would be totally acceptable. But I always like to go with the simple wave counts. And in this instance here, I think a flat works. Where you have simply A, B, C down, 3-wave move for wave A, 3-wave move up for wave A, then you got an expanded flat on a wave B, and then you have an impulsive move up, so that's wave C of B of the flat, followed by the 5-wave decline, which looks like an ending diagonal. Simply put, it looks like this March low in many of the metals that I'm currently looking at. And it doesn't matter. GLD, AUY, DRD, wheat and precious metals. A lot of these charts look really exciting. So spend some time and take a look at that over the weekend. But I like the idea that we may be working something impulsive here, or finally that the consolidation that we've seen since the peak back in last year, and this would have been August of 2020, that maybe this is complete. Because if this is an ending diagonal, well, how do prices resolve following an ending diagonal? Very swiftly and very sharply, and back to beyond the origin of the pattern here. Okay, so play with that. Let me see, Roku. Okay, we're going to play with Roku for a moment. What do you see when you look at this price chart? Now, whenever you look at a price chart, you can either take a big view or you can take a little view. Think of, okay, and when I say big view versus a little view, think of, okay, big view. What would be a big view? Maybe a telescope, okay? You're looking at the whole picture. You're looking at that panorama. You're looking at the view standing on the Grand Canyon. Or you can take more of a singular view, a very small view, where you're looking at the market through, say, a microscope. Okay, in this instance here, I'm using a small view. I'm looking at that rock at the bottom of my feet. And what I observed in Roku the other day was this, the bearish engulfing pattern that we put in yesterday, right here on the 14th. Okay, interesting. We've moved above the Donchian average. That argues that the trend is up. We now have the bearish engulfing pattern. Maybe we've got 5 waves up and we're going to come down here, because that's one of my favorite trade setups actually. I want to see prices move above that Donchian average, and then I want to see prices come back down and test the opposite side of the Donchian average, and then ideally at that point the stage is set for something more significant to the upside. Okay, so let's look at the smaller term, shorter term substructure here. Okay, well, if we look at the 60-minute price chart of Roku, this works. 1, 2, 3, 4, 5. Okay, so I've got 5 waves up. What's going to happen next? Well, I should see a three-wave decline, so probably into next week, probably back down into this area. Now, honestly, I don't care if this is A or 1 or B or 2. Makes no never mind to me, because really from a trading perspective, certainly a short-term trading perspective, the next move of consequence following our pullback is going to be another advance to the upside, and we can call that wave C or we can call that wave 3. So what I'm doing today is I'm aiming in front of my target. So next week, when we look at Roku, I want to see what happens if we can trade back down to the 350 area. Because, so that's what I'm referring to when we talked about this diagram here, aiming in front of my target. So I'm essentially up here, and I want to wait. I want to give the market time to pretty much support and bolster the view I have for Roku. So 5 waves up, let's look for a decline. Let's see what happens here. Let's aim in front of the target. Now the final market we're going to take a look is going to be Lululemon or Lululemon. Ticker symbol is LULU. Pretty straightforward, although there's a kind of a trick in here that you're going to have to work with. Okay, now from the get-go, the way I would look at this is a zigzag. And the reason I would say it's a zigzag is because of the slope analysis of the structure. Whenever you're working a zigzag, your wave A tends to be very steep, very aggressive, very sharp. Wave C of a zigzag tends to be more shallow. So as far as the slope signature, this has the slope signature of a zigzag. Now the slope signature of, say, a flat correction is going to be a bit different. You're going to have kind of a time-consuming wave A, your corresponding wave B, and then your wave C is going to be a little bit more, say, decisive, typically less aggressive. Now this isn't always the case, but it's what we look for. It's what we like to actually see. Now the problem in identifying the December decline in Lululemon is the overlap. Okay, and this is where I get questions from some of you, a very small view, is just like, okay, is it okay if wave 4 moves into the price territory of wave 1, or is it okay if wave 4 terminates in the price territory of wave 1? Because it didn't happen on a closed chart. Well, I don't like the gray area sometimes. I like to keep things, think about it. The wave principle, it's laid out for us quite clear. We have rules and guidelines. And if you're going to follow the rules and guidelines, then what you're doing is the wave principle. If you're not following the rules and not following the guidelines, then what you're doing is not the wave principle, and it's whatever you want to call it. But this is an issue. Okay, we can't have that. Okay, and I don't really care if there's no overlap on a closing basis. I want to keep things clean and clear as much as possible. So the way around that is to simply identify a running triangle in your 4th wave position. Okay, so what you actually have is wave A entering into the price territory of wave 1, but the termination point of your running triangle, wave 4, ends well. Here's the ending point of wave 1, here's the ending point of wave 4, there's the thrust out of the triangle. Totally fine, totally works. And what's going to be interesting moving forward is if we can keep the market above the April low, and then at some point begin to move above the upper boundary line of the base channel, thereby confirming the presence of 3rd wave price action. Because as it stands, the sell-off that we've seen does look like a 3-wave move, and it does argue for higher prices moving forward, at least into June, July. Okay, a few more things. Okay, that's our Elliott Wave assessment. Remember the lesson that we were talking about earlier, well actually yesterday when we had our discussion of hot dogs, okay? Okay, you can add things. Let's add to this. Here's our RSI stochastic page. RSI is in RSI bull market support. You got an oversold stochastic. This is my favorite little momentum pattern right there. RSI reversing from RSI bull market support with an oversold stochastic. We're back in the same sweet spot. Also, too, take a look at the weekly candlestick price chart. What happened a few weeks ago? We had a bearish engulfing pattern. that failed, okay? What happens when you have a failed bearish engulfing pattern? Well, it's actually bullish. Okay, sometimes the best buy signals originate from failed sell signals. Sometimes the best sell signals originate from failed buy signals. Case in point, that was a bullish engulfing pattern. It failed. And what happened as a result of that? We saw several weeks to several months of further decline. Okay, so we're basically working the same thing, but to the upside at this point. That's about it for me for today. Thank you very much. Have a great weekend, and I'll see you next week.